Hi, I'm Mark Pizzacalla, and welcome to What You Need to Know with Dr. Mark. Now, the year is young, but there is a lot going on, and there's a really important tax case that's just come out in January this year called the Guardian decision. And the Guardian decision, it's got all the elements of a tax thriller. It's got tax planning, trust distributions, agreements or lack of agreements, and of course, whether or not people are paying the right amount of tax. So it's got all the elements there. What happened? Well, let me just explain to you briefly what happened. I've got a diagram for you. Essentially, a trust makes a distribution to a company. That company pays company tax. In the subsequent income year, it makes a distribution of that dividend to a beneficiary. The beneficiary is a non-resident. As a result of that, and because it's a frank dividend that flows through, the beneficiary pays no further tax. So in essence, what happens is that there's no top-up tax being paid, i.e. there's company tax being paid, but the individual is not paying tax at the highest rate of marginal tax for a non-resident. So look, that's the background. What did the ATO do? Well, the ATO wasn't particularly au fait with this arrangement. They weren't happy with it. And they said, well, look, we're going to rely on a couple of really important integrity provisions. One is Section 100 capital A, which is a reimbursement agreement provision. And the other one, of course, is Part 4A, where if you're able to identify a dominant tax benefit and a scheme attributed to a taxpayer, it's a really important provision. Now, essentially what came out of all this, though, is this. With a reimbursement agreement, you need to be able to demonstrate that there's an agreement in place and that the funds or the monies or the property that's being distributed doesn't, it goes to anyone but the individual that's the actual beneficiary of the distribution. Now, in this particular case, it was being argued by the ATO that's exactly what was happening. As a result of this arrangement, the funds were going, in effect, to the taxpayer, not to the beneficiary that it was originally intended. It's really a washing machine effect that's been going on, and that's what was being argued. In the end, the court indicated that there was no agreement in place, and therefore Section 100A did not apply. Having said that, there's also exclusions under that provision for family and commercial dealings. There were no family dealings or commercial dealings were considered because there wasn't a need to. It would have been nice if the court took a deeper look at that. Secondly, in relation to Part 4A, well, at the end of the day, in the first year where this occurred, the court indicated that there was no Part 4A because, look, it was an evolving structure. However, by the time the second year arrived, the court felt that it was pretty clear what was going on and that Part 4A did apply. So look, really important decision. If you're advising on distributions, agreements, family groups, a critical decision to get across, and I highly recommend that you have a read of it before this year's year-end tax planning. Any questions, give me a call. Hope you have a great 2023. Speak soon.